Hello, everybody. This is Eddie Hardeni. Let me put on my other glasses here. I flip from one to the other. It's Wednesday, actually, June 24th at 8:39. The reason that I'm recording this in midweek is because on Monday that we had technical difficulties. So I did do a live webcast, but it did not record. So I didn't want to leave you folks out who get it on Wednesdays and Fridays. I'm going to review some of the points that I made back then. I thought Max was here, but I guess Max decided since he'd heard it before, he wasn't going to stay. Look, first of all, I hope you all had a great Father's Day on Saturday or Father's Day weekend, anyways, on Saturday and Sunday. The weather was really quite nice here in New York, and so that went very well. I have five kids, and I think three of them showed up with two grandchildren. So it was fun. Also fun has been the ups and downs in the stock market. Well, maybe not so much fun, but if you just ignore all the short-term volatility, the trend has been right. And of course, on a regular basis, we have to assess whether the trend is still to the upside. I've been arguing that on a short-term basis, there might be some June swoons in the market, and so far that seems to be playing out. We made a high of a little while ago, not too long ago, but since then, I think the market has been troubled by a couple of things. First of all, there's the Middle East crisis, and I don't know that the market should be particularly troubled about that because we've seen oil prices go down rather significantly, and everybody's scratching their heads and wondering why the price of oil never got up to $150 to $200, and now why it's right back to where it was basically before the war so quickly. And I think there's a lot of answers, but I think the most important one is probably that China's demand for oil has been flat to down. They've adopted a lot of electric vehicles. They have a lot of reserves, strategic reserves, and that helped to reduce things. But they've gone, increasingly using alternative energy sources, and so that probably explains why the price of oil is down. We did have a bear market in the oil market from about 2022 when Russia invaded Ukraine. There was a big spike up there in oil prices, and since then, until the war started in March, the price of oil fell quite sharply. So I think that explains that. The market should take comfort from that. So what's bothering the market? Well, a few things. One is last week we had a new Fed chair give his first press conference, and everybody was surprised. I was surprised how hawkish he came out. Kevin Warsh had been a Fed governor from 2006 to 2011, and as a Fed governor, he always voted with a consensus, but he also made it very clear that the last couple of rounds of Fed easing through quantitative easing, he was not in favor of. So he was in favor of QE1, but he did not like QE2, and he seemed to worry more about inflation making a comeback than anybody else did at the Fed. So he was more hawkish relative to the crowd back then. But the crowd back then was worrying about deflation, about the labor market, and so they were providing a lot of liquidity and zero interest rates. Anyways, he left. Then he became one of the candidates for the job at the Fed chair. And I don't know. I mean, if I was interviewing Kevin Warsh, and saw what he said at his press conference, I'd be pretty annoyed. Trump seems to be taking it pretty well, but Warsh was very dovish when he was interviewing for the job and said that, we shouldn't worry about inflation. It's transitory. Productivity is making a big comeback. AI is a big productivity booster. That'll keep inflation down, give us more growth. So why not lower interest rates? And it sounds a little bit like the roaring 2020 scenario with one difference, and that is we don't want to melt up in financial assets, particularly in the stock market. And there's really no reason to lower interest rates if you're getting better growth and lower inflation from productivity. And there is a reason to keep interest rates higher than Kevin Warsh was arguing for not lowering rates, and that is financial stability. But at any rate, now that he's Fed chair, suddenly in his press conference, he's mentioning that the Fed is committed to price stability. Mentioned that several times. Didn't mention the labor market, but said labor market's doing quite well. And so the market kind of went our way. We had been arguing about over a month ago that the Fed would flip from an easing bias to a tightening bias. Most people thought it would be maybe a neutral bias, but they did go to a tightening bias, as was evident in the dot plot that the Fed puts out showing the various projections of the 19 participants of the FOMC. It turned out to be 18 participants provided dot plots. Kevin Warsh abstained, if you will. And he also he doesn't want to do forward guidance, but he didn't get rid of the dot plot just yet. Maybe he will down the road. But then he also made it very clear that he was quite hawkish. Now, there's one theory that he knows oil prices are coming down, and he believes that productivity is making a comeback, and maybe he's counting on inflation to come down surprisingly well, in which case the tightening bias stays a tightening bias. They don't raise rates. They keep saying that maybe we don't need to raise rates after all, and maybe they won't. I'm still thinking that there might actually be a July increase of 25 basis points because I think the economic data is going to look pretty good, and I think there could still be some impact of the price increases we had in oil in the rest of the inflation news. So I'm talking about the core inflation rate might still be hot. And I think the key point that I've been making is, along with my new colleague Elias, is that the Fed has missed its target for 5 years now. For 5 years, the Fed funds rate, the inflation rate has exceeded the Fed's 2% inflation rate target. And wouldn't you know it, Kevin Warsh mentioned that he actually acknowledged that the Fed has blown it for over 5 years, and now he's committed to getting it down to the Fed's target. So I think that's got the market a little bit concerned. What else? Well, the AI trade is just full of uncertainties now. We went from having an AI trade where the hyperscalers were showing big increases in their cloud computing revenues. As a result, the hyperscalers said, boy, we could be making a lot more money if we had more compute, so let's build more data centers. And the market started to rebel against that, saying, well, they're spending way too much on building data centers without really knowing whether they're going to get a decent rate of return on it. And then along the way, just recently, actually, we have had some data showing that the price of compute, namely what they call tokens, that price has come down. That implies that there's actually right now more compute than the market needs, or at least there's more competition for the compute that's available. And what else? Well, a Chinese company, not DeepSeek, but another Chinese company has come out with a really cheap AI LLM model that is open source. And again, that raises the question of competition, and do we really need to be spending all that money on data centers. And of course, SpaceX came out, rallied for a few days, and now SpaceX has come down for a few days, and SpaceX's kind of uh, moonshot dream is that SpaceX will be sending lots of data centers up into space. And again, that's kind of pie in the sky, if you will. Uh, we know it's going to cost a lot, and whether all that compute is going to work and what the cost of maintaining it is an issue. Meanwhile, we've got FOMO versus FEMO. FOMO is fear of missing out. We seem to have less of that here in this June swoon environment. The market was driven up to a certain extent during this bull market by FOMO, by fear of missing out. However, the fear of missing out really applies to the forward PE of the stock market. And the forward PE of the stock market has kind of stabilized around 20 or so. And so over the past, well, so far this year, most of the increase in the stock market has been what we call FEMO, which is fabulous earnings momentum. Earnings have been very strong. And as a result of that, the analysts have increased their expectations for earnings. Basically, the earnings that drive the market are determined by analysts. The consensus analyst forecast is what we look at. And that's the earnings side of the equation. The valuation side of the equation is determined by investors. How much are they willing to pay in terms of the PE for the earnings expectations of analysts? And when you get FOMO, you basically get investors believe that the earnings are going to be a lot better or much better than analysts expect. When you get FEMO, it turns out that analysts are delivering better than expected earnings outlook. And then maybe what we're seeing here is less FOMO, that investors are kind of losing their confidence, especially in the AI trade, in the reliability of those earnings estimates. I think that doesn't mean that we're going to get a big correction or a bear market. I think it means we get rotation back to some of the more old-fashioned stocks where earnings are more predictable and there's less uncertainty about all that. And we've sort of seen that. Not all tech has taken a drop here. Some of the AI still looks like it's holding up, like the memory. Software is not. But we are seeing the 493, the S&P 493, outperform the Magnificent Seven in recent days, recent weeks. Actually, since the beginning of the year, that's been the case. The Magnificent Seven are down a bit so far year to date, whereas the 493 are actually up about 14%. So the market's already sort of broadening out or kind of re-rating where investors feel comfortable. What else? We are seeing that the Russell 2000 all-time record high. So that suggests again no fears of recession, perception that the economy is doing very well, and that not only the large cap stocks are likely to show better earnings, but so are the smaller cap stocks. I think that's kind of what I covered on Monday. Again, we had a technical difficulty, so I couldn't give you a recording of what I did on Monday. But I didn't want you to miss out for those of you who get it on Wednesdays and Fridays. So I did want to record it. Let's look at a couple of charts here quickly. Will the real Kevin Warsh please stand up, is what we did in our morning briefing. And Warsh was a Fed governor to a large extent when Greenspan was around. Well, actually, not a large extent, so 2006. So I guess around here to 2000. Let's see. Yeah. No, he was Greenspan and Bernanke, so 2006 to 2011. As you can see, he as I mentioned, he was for QE1, which occurred right around here, where the Fed had to lower interest rates down to zero. But then by 2011, he just said, you know what, I'm not. I've got a better opportunity in the hedge fund community. He did point out that when he was getting interviewed, the productivity is making a rapid rebound, and that should keep inflation down. But he didn't really mention any of that in his hawkish presser. He did mention that the CPI inflation rate has been above the Fed's 2% target, and pledged that the Fed would be committed to bringing back price stability. How do you get that without raising interest rates or being lucky? And in our roaring 2020 scenario, he might actually be lucky. So we're not dismissing that possibility. But then we had 9 out of 18 Fed participants, FOMC participants, voting for at least one, maybe two rate hikes, which was consistent with our prediction that the FOMC would get more hawkish. The AI trade, which is supposed to be deflationary by increasing productivity in the short term, has certainly driven up technology prices. Let's just quickly jump here to the morning briefing, the quick takes that we wrote over the weekend, which I also covered in my Monday webinar, is Irrational Exuberance Driving FEMO. Irrational exuberance really applies to the PE of the technology sector back here, going straight up here, driving up the PE of the S&P 500. And so that was a lot of that was FOMO. The bull market was driven more by PE than by earnings. And this situation is completely different. We've seen the PE kind of go up here, but now it's settled back down as investors have said, well, these earnings estimates are a little too rich for us. Maybe we're not going to pay a high PE for it. So it's radically different from what we have here. And the question is, can there be such a thing as irrational exuberance in FEMO? In other words, are the analysts too exuberant? And this chart suggests, well, maybe they are. This is their expectations for earnings growth over the next 5 years at an annual rate. And you can see this thing has just soared for technology, which in turn has led the expectations for the S&P 500 to go up. And so we're way above anything that we saw back here. And presumably this was based on reality. This is based, for example, on what happened in Q1. The earnings season was very strong, but some of that was the quality of those earnings is kind of what raises a FEMO issue. Was the earnings really that good? Well, part of that might have been circular financing and in the AI trade. Part of that might have been a situation where some of these companies own stocks, AI companies own stocks in other AI companies, and maybe that's kind of hyping things up a little bit. But again, the investors are already kind of thinking along those lines. I would point out, though, that the forward earnings of the Mag 7, while they have been very strong, so has the 493. So again, that's an argument for the market rotating. Forward earnings, all-time record high. This 2006 increase may reflect some of that questionable earnings in terms of are they really operating earnings or kind of one-time earnings. This is encouraging. The forward earnings, the S&P 500 has gone to a record high, but also for the SMID caps. So again, that's consistent with the earnings picture not being all that tainted by some of these issues. Yeah, I think that pretty well covers it. The bull-bear ratio is neither bullish nor bearish, which allows for the market to go higher because we don't have too many bulls. Price of oil's come down. Oh, gold, people have been asking me about that. Yeah, it's not working out too well. Worked out great here. Now we've gone through the 200-day. Now we're retesting 4,000. I would say if we break down below 4,000, then we got a problem with this trade, maybe even on a long-term basis. But we'll see. It's right now it's questionable whether we're going to go back to 5,500. which is our year-end projection. But we're not feeling that confident about it, obviously. Fed market's expecting two rate hikes over the next 12 months. 2-year notes expecting the Fed to raise rates. And that kind of covers it. So thanks for joining in. Again, we recorded on Monday. I thought we were recording, it didn't work, so I didn't want you to miss out on what we had to say. So this is, I think, a pretty thorough recap of everything we did have to say. Thanks very much.